After Poland's central bank cut its interest rate last week to an all-time low of 3.25%, some economists are now saying this is a crazy decision and 50 basis points is unnecessary. Joining me on the line is Michal Dybula, Chief Central European Economist at BNP Paribas. Hello, Michal. Michal, do you agree this is a crazy decision and 50 basis points is unnecessary?
Well, definitely not. I think the move has been rather a kind of belated catching up with reality, which is that one of very weak economic growth and quickly fading inflationary pressure. So the move was entirely justified, though it has been catching the market by surprise, especially in light of some earlier policymaker comments that the easing cycle is basically gonna come to an end, or that the central bank is gonna pause the easing cycle. So from that viewpoint, it was a surprise, but based on the macroeconomic fundamentals, it has been an entirely justified move.
Polish Central Bank Governor Marek Belka says the central bank isn't ruling out more interest rate cuts if economic growth undershoots its expectations. Do you think more cuts are a good decision?
It is reasonable, right? I mean, in a way, if we're gonna get hard data that will basically suggest that the economy is moving at a slower pace that is currently discounted or expected by the central bank, and that inflationary pressure is further abating, then further policy easing will be absolutely justified, and it seems like that is going to be delivered.
Forecasts show economic growth will slow to 1.3% this year, the weakest pace since 2001, and down from the previous estimate of 1.5%. What are your predictions for growth in Poland this year?
Well, I had been expecting actually GDP growth to average 1.3% in 2013 for quite some time. I don't think the point forecast is really so important at this stage, but we need to understand that first of all, this is a significant slowdown. It is significantly below what policymakers, what also the markets have been expecting even a couple of months ago. And we also have to understand that this is a totally different type of slowdown than previously encountered, particularly in the years of 2008, 2009. Right now, it has much less to do with the external side of things, with the recession and the eurozone and collapsing external demand. It is a much more domestic demand driven slowdown. We had the first fall in private consumption in Q4 of 2012, and it was the first time since actually the beginning of 1995. So this is something that is entirely new, and of course the impact, for instance, on inflation of such a type of slowdown is also going to be completely different than what has been seen, let's say, a couple of years ago. It's going to be much more disinflationary.
And rising unemployment, currently standing at 14.2%, is hurting consumer spending. What are your unemployment forecasts for Poland this year?
Well, I mean, on the official unemployment rate side, I think it's fair to assume that we're gonna average the year of close to 14%. The unemployment rate has already risen above 14%, and in the first months of the year. To some extent, this is partly because of seasonal effects, as this is a non-seasonally adjusted figure. As we move later into the spring and summer months, the kind of seasonal unemployment is going to be decelerating, so we're going to be moving again below 14%. But as said, I mean, on average for 2013, it is fair to assume that it's going to be close to 14%.
What are your main concerns for the Polish economy now?
Well, I guess in the near term, the biggest concern is that economic policy cannot actually do much to stimulate a faster recovery and growth, a faster rebound in domestic demand in particular. The government needs to keep fiscal policy tight, so there is absolutely no scope for discretionary fiscal stimulus, so completely unlike the situation in 2008, 9, and 10, where the government had the fiscal scope to increase budget spending and to support aggregate demand. This is not the case anymore. The second factor is of course, that the transmission mechanism of monetary policy is working less good than this was the case before the global financial crisis. So simply the impact of lower interest rates on credit growth, for instance, is much more muted than it was a couple of years ago. So in the near term, as said, I mean the policy response, even that we have seen the cuts being delivered by the MPC, the impact is going to be weaker than let's say it would have been some years ago. In the medium term, I guess the biggest concern is that the potential rate of economic growth is slowing down, and that this is most likely going to continue because of the deceleration in investment growth, or basically the fall in investment that we're going to see this year. And also because of adverse demographic trends, which is probably a bit more of a European phenomenon. So it's not entirely something only that matters for Poland. But this deceleration in potential growth, I think it will have significant implications for fiscal policy, for instance, if the government will remain committed to further deficit cuts and the reduction of public debt to GDP ratios. Further fiscal tightening is most likely going to be necessary, which will not support the growth path either.
Thanks for joining me, Michal. That's all for now, but stay tuned to Dukascopy TV for the latest financial news and updates. Goodbye for now.